Just like our economy, there are a lot of flat out lies that everybody needs to be aware of that are circulating right now about real estate, because everybody wants you to believe that this is the best time ever to go out and buy a house, and that's simply just not true, guys. There's been many times in the past would have been much better times to buy a house than right now, but everybody wants you to think that the best time is right now. Now, the first lie is how much affordability has improved, and that's supposed to get people off the sidelines right now to go out and buy. Now, yes, interest rates have been coming down over the past couple of months, but over the past couple of weeks, they've actually been going back up, and it's actually closer to 7% again, whereas for a while it was hovering in the 6.5% range. But all of the real estate people are trying to make everybody think you should go out and buy right now because the rates dropped. It's not 8% no more, it's 6.5%. Oh my God. And here's one of the examples that the news gives about why this is good, guys. Let's take a look at this. Home buyers with a $3,000 a month budget for their monthly mortgage, which is already beyond what most people can afford, because that means your monthly income is closer to $10,000 a month, which we know basically nobody makes that in the country. There's very few high income earners that make that level of earnings each year. But anyways, let's proceed. So they're saying that now somebody like that can afford a $453,000 home because of the lower interest rate, and that buyer's purchasing power has increased $40,000, because if somebody wanted to buy that same house in October, they would only be able to afford a $416,000 house with a 7.8% interest rate. So that's supposed to be enough to get everybody off the sidelines and go out and buy. But like you just heard, this applies to somebody who's looking to buy a $450,000 house, which is outside of the budget of what most Americans can afford. The average household income across the country is $75,000 a year. In order to buy a house that costs $450 grand, you would need to make about $120 grand a year. So that is way beyond the average salary, guys, way beyond the average household income. So how much extra people can really afford is actually much smaller than that. Now, yes, you can afford more than you could have a couple of months ago, but has that really helped anybody? Has anybody went out there and said, oh, you know, I'm willing to pay more for this house now that the interest rate dropped my payment by $50 a month? No. So once again, this is something that benefits basically just the top 10% of earners in the country the most. Here's another big lie that's being told right now. It's okay to spend more than 30% of your monthly income on your house payment, whether you rent or own. And that is a huge lie, guys. There's this guy that's supposedly a household finance expert. I can't even pronounce his name. Andres Shidajaj. I don't even know. You guys can look at the story if you want to take a look at it. But anyways, he says that 30% of your monthly budget on housing should be more like a guideline or a rule of thumb, but doesn't have to be adhered to absolutely. And while there's also there's always a little bit of truth to lies. That's the funny thing about lies, right? There is wiggle room. There is an opportunity for people to go above that, of course, and your mortgage lender will easily let you go above that. I've seen people get mortgages with 45% debt to income ratios, so that is far beyond the 30%. So yeah, can you go higher than that? Yes. Should you? Probably not. But they're saying, 30% is just an arbitrary number. Don't rely on that. It's more just a guideline than anything. Also, the more money you make, the less you have to worry about that 30% guideline. Like, what? So you're telling people that if you make a lot of money, you should go out and dedicate more than 30% of your income to a high house payment? Why? What's the purpose of that? Right now you have more than half of Americans who spend more than 30% of their household income on rent each month. So obviously a lot of people are in this boat right now, but those people are not in that by choice. Most likely it's because the rent is too damn high. Also, according to the US Census Bureau, 27.4% of homeowners are cost burdened, or essentially house poor, which means that they pay more than 30% of their income on housing. And that's how dumb this is, guys. That's how much of a lie this is, that you have financial supposedly experts out there telling people go ahead, spend more than 30% of your income on housing. It's not a big deal. It's just a guideline. So don't worry, just go ahead and join all the other people who are house poor right now, because you're in good company and misery loves company. That's what they're telling people here. I'm not making this stuff up. You can go read this story for yourself. I always link all the stories I talk about down in the description below for anybody who wants to go check this stuff out. Now, in all fairness, if you live in a very expensive area like New York or San Francisco or LA, even Miami now, sticking to this 30% rule is probably impossible unless you are the top 1% of earners. So most people don't fall in this category, so you're probably gonna have to go over it. And there's not much you can do about it other than move or make more money. But if you're somebody that has the choice and is going over voluntarily, you are essentially putting yourself in a precarious financial position by choice. Now, here's some reasons this supposed financial expert says it's okay to spend more than 30% of your income on your house. First of all, you need a place to live, and housing has what economists call a consumption value, meaning housing is literally a good that you consume and enjoy. Okay, I follow so far. Second, housing has value as an asset. As of 2021, home equity represented about 28.5% of the household wealth in the United States, according to US Census Bureau. So this has people thinking completely backwards about housing right here, guys, because no matter what you've been told, your house is not an asset unless you rent it out. Unless you turn that into a rental property that is producing income and putting money in your pocket, your house is a liability. It's not an asset. The only day it becomes an asset is on the day you sell it, assuming you make a profit. If you don't, then it's still a liability. And listen to this paragraph right here. This is just mind-blowing when I listen to this stuff. That's how rampant these lies are right now. Households have at times had so much wealth in their home equity that the idea of using your home like a piggy bank became buzzworthy in the mid-2010s, and homeowners continue to tap their home equity to access loans. Your budgeting for housing can depend on how you value your home. So they're basically telling people it's okay to spend more than 30% of your income on a house, so that way you can get into a house that's supposedly going to be worth all this money, so that way you can go ahead and borrow against it and get further into debt to finance the lifestyle you can't afford? I mean, you can't make this stuff up. It's just unbelievable. Really, it is. Additional logic they use here is that, well, if you're somebody who's not home a lot and you just like to travel and, have fun and spend most of your money outside of your house, then it's okay to spend 30% or less on your cost of housing. But if you're somebody looking at it as an investment and that your house is going to be a major future source of wealth for you, then it's okay to spend 30% or more of your income on the house. Well, how do you know that, guys? How do you know if your house is going to be a future source of wealth for you? Because I'm sure a lot of people thought that back when they were purchasing homes in 2005 and 2006, and then they ended up finding out the hard way that ended up not being true, unless they held on to it all the way until today. Here we have a house for sale for $4.2 million, which is a botched attempted flip. They bought it back in 2020 for $2 million, and now all of a sudden they want double. But actually, they listed it for sale just a few months after buying it for $3.1 million, thinking they were going to get that quick cash. Didn't happen, so they rented it eventually. It took a whole year. This house sat empty. They rented it for $30,000 a month. Now they're trying to get double what they paid for just a few years later, with a property tax bill of $48,000 a year. But in all honesty, if you're paying $30,000 a month, you might as well own this place, because that's what it costs to own it with a 20% down payment. And the next lie that seems to never die, really, you can always buy now and refinance later. And I am not going to go into detail on this because I've made a couple full videos on this in the past. But in a nutshell, guys, that is also not true. Because if you are somebody that buys today and you believe this, okay, you say, well, I don't really want to pay a 7% mortgage, but I'll pay it now. And then once it goes down to the 4% range, I'll refinance. Well, if you do that, and your home value is not there, when it's time to go for that 4% interest rate, you won't be able to refinance the house. It's that simple. And to make matters worse is even if the value of the house is still there when interest rates reach 4%, let's say for example your income situation has changed, or your job situation changed, or the amount of debt that you're carrying if you're following this ridiculous advice here and borrowing more and more against your house. So let's say you're somebody that did that and believed these lies, okay, and just got further and further into debt with your house and all of this, and you want to refinance. Well, oops, we're not going to refinance you even though your house is worth more now, because now your debt to income ratio is higher. Yeah, that can happen, guys, and that's something I haven't mentioned here on the channel before, and I want to make it crystal clear that there are a lot of different reasons that you might not be able to refinance when the time comes. And you know what? People can say whatever they want about me, because people say sometimes that, oh, you're just out here spewing gloom and doom and never have any good news, blah, 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 blah. I'll tell you what though, guys, what I never tell people to do is I never tell people what all these supposed financial experts are doing, is telling people to jump in way over their head, get massively into debt, and then somehow figure out a way to sift through all of it and make it through to the end where you're going to be rich somehow at the end of all of this because your house went up in value. Like these are really bad financial decisions that people are making because they're hearing the wrong advice. So I'm never doing that to people. And then you have people that say, oh, you're always talking about all these problems, but you're never giving people any advice on how to fix it. Well, here's the advice on how to fix it. How about not following this ridiculousness? How about not doing these things that you're hearing people are doing and getting themselves into trouble, getting themselves upside down financially? How about just not doing that? I think that's a pretty good start. But honestly, guys, I don't consider this an advice channel. I didn't start this channel to tell you how to live your life and, give you all the right advice. What I'm doing here, I consider to be like a heads up. This is a warning about what's going on out there. What you choose to do with it is up to you. I can't tell you what to do because everybody's financial and life situation is different. So if I were to sit here and give advice, that would be saying that, one size fits all and everybody's life is the same, which is definitely not true. In fact, I still think it's beneficial to keep waiting out this housing market because as of the most recent sales data in December, okay, home sales are continuing to go down, guys. Right now, it's at a 3.78 million annualized rate. Well, in 2023, we had about 4 million home sales, which is down significantly from the previous 2 years. If it goes down to 3.78 annualized this year, okay, that's going to be probably the worst year on record in modern history, which means that people aren't buying houses except for the very rich, the ones that can afford to pay cash for everything. Don't have a care in the world about the current financial situation of this economy. And I don't see how there can be a meaningful uptick in sales activity in 2024 without a major increase in inventory. And if we get that major increase in inventory, chances are you're going to see lower prices come along with it, which is going to be a benefit to people who have been waiting, like I keep telling everyone. But according to Realtor.com, inventory is increasing little by little, guys. It's not happening in massive surges or anything like that, but it is going up because in December of 2023, there was about 4.9% more homes for sale than in the prior December of 2022. So things are on the right track as far as inventory goes. We're starting to see the inventory come back, but we're not seeing a surge of it yet. And the reality is a lot of things simply can't be trusted right now in our system, because let's talk mortgage rates for a second. When we saw interest rates for mortgages at around 8% in October and then plummet all the way down to close to 6.5% a couple of weeks ago, but now it's almost 7% again. So it has swung pretty dramatically in the span of 2 months. You normally don't see this level of change with interest rates. And here's what's interesting, guys. What has happened in that meantime? Has the Fed lowered interest rates? No. In fact, there was huge market bets that there was going to be interest rate cuts by the Fed by now, or at least by March of 2024. Now that looks like that's not going to happen. These guys were wrong. The rates are going to stay higher for longer. And now you're starting to see the interest rates for mortgages tick back up. And why is that? It's because the markets were getting ahead of themselves thinking that, oh, inflation is down and this is all over with and they're going to start cutting soon. So you start seeing the yield on the 10-year treasury go down, which in turn makes interest rates for mortgages go down. It was all putting too much emphasis on a potential rate cut that hasn't materialized. And that's why you're now starting to see rates go back up again. This small temporary dip in mortgage rates was used as a way to try to push people back into real estate. Even though it didn't work, it's not like a bunch of people went out and bought because these rates went back down like that. In fact, the mortgage applications were falling during the majority of that time. So luckily, most people didn't believe the lie, which makes me very happy to see. Or maybe it's not that they didn't believe the lie, maybe it's more just that they actually can't afford to believe the lie. They don't have the budget to believe the lie because the median home price has surpassed the median household income. And what the average person needs to understand from all this is what this all equates to is volatility, guys. All this means is that there's no certainty in the market right now. One day rates are up, one day rates are down, one day the stock market's going up, one day it's going down. There's a lot of uncertainty about what's happening out there. We saw, the jobs numbers come in lower and lower throughout 2023 and then being revised down. And then as soon as we get this big, wonderful report in January, everybody's jumping for joy. So once again, that's volatile. If everybody who's been anticipating a rate cut soon, well, check this out. The economist over at Santander, Stephen Stanley, he's only expecting 2 rate cuts this year for a total of 50 basis points, and that he thinks that we're not going to see a single rate cut until after the election, guys. Imagine if that happens. Imagine how much that's going to throw off all these investors' expectations and what that's going to do to mortgages and the economy, the unemployment rate, everything, if this actually ends up being true. Basically, the last few inflation readings have infused investors with hope that the economy is on track to cool down after a ton of price increases. But he thinks that the inflation numbers this year aren't going to look as strong as they did last year. But also there's a political aspect to this. Surprise, surprise. If the Fed starts cutting now, they risk looking biased towards any presidential candidate. So there's political reasons for this too. If the Fed waits to cut interest rates until after the election, it won't look like they were trying to artificially help any given presidential candidate. So the Fed could have political motive here to just leave interest rates the same and stay where they're at until after the election so they don't get a bunch of heat from this after the fact. Because say, for example, we don't get a rate cut in May, half the year is already gone, guys. So that makes it even closer to this prediction actually coming true. So I don't know. Let's see if that's going to happen. This is not my prediction. This is Stephen Stanley's from Santander. He's saying this is going to happen. So everybody has their predictions and opinions, of course. But what I gather from all of this is every time we think we know what's going to happen, we keep getting surprised. We keep getting blindsided and things don't go the way that we thought. We thought by now we'd already be seeing a housing crash. Housing's still really expensive. We thought by now we'd see the stock market crash. It's still very expensive. But everybody needs to understand that all of this is being held up by an insane amount of debt, an insane amount of borrowing that's going on to keep people spending in this economy, guys. And like I've been saying, it's been a common theme of these videos, is that dynamic cannot continue forever. Either people are going to run out of money and run out of credit available to them to spend, which will naturally slow the spending down, or you're going to see lenders pull back on the credit lending, which is something we've already started to see happen because of the amount of delinquencies that have been on the rise. So I think little by little, as time goes on, the liquidity in this system is going to continue drying up and drying up to the point where things will just slowly slow down. We're not seeing the major crash like we saw back in 2008 where everything kind of happened overnight. It's just kind of a slow burn and a slow death is what it seems like to me. And there's a strong possibility too that after the election's over and when we hit 2025, that's when things can really start to go downhill, because then it's all bets are off. Nobody has any, political motivations to protect any of their candidates anymore. Speaking of elections, I think this guy doesn't know who he's voting for yet. Oh man. Going to start getting ugly out there pretty soon. But I know some people have definitely listened to a lot of what I've said here on the channel and has helped people out tremendously, which really makes me feel good, guys. And I hope that more people start taking these things into consideration and start listening to all the mistakes that other people are making financially in order to get yourself ahead financially. That's like one of the greatest gifts I feel like I can give here on YouTube. And the fact that people are taking advantage of it is really awesome. So if you guys enjoyed this video, make sure you subscribe to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.